Hello everyone, my name is Rishabh Kumar, Assistant Professor, School of Commerce, Gloria University. So today we are going to start a topic that is called growth investing versus value investing. So being a trader or being an investor, we should must know that who are called the growth stocks and what are called the value stocks. So here we can see that the growth stocks are those stocks which are expected to grow significantly in the future. So in the mind of the investor is that in the coming future the growth of the company are expected to be higher, means higher potential of growth in the future, but supported by strong revenue earnings, market share and growth potential. But in case of value investing, what we are seeing that these are mostly the undervalued as stocks based on intrinsic value. Now take an example. Here we have a stock of rupees 10, but due to some market conditions or unfavorable circumstances, now it is selling price is rupees 8. Now it is selling at price rupees 8. Now what will happen? There is a difference of rupees 2. If I am the trader and know the worth of the value of this stock, that is rupees 10, now it is selling at rupees 8, so definitely I will purchase this. Why? Because I know that now it is 8, but definitely it will rise up and it will goes beyond rupees 10, and that will be my profit. So such stocks are nothing called but a undervalued stocks. So these are typically based on some fundamental analysis and the metrics. What are kind of metrics? Like PE ratio, price to book ratio or dividend yield. In case of growth, what we have seen, what are the matrices? Matrices are future revenue earnings, market growth potential. Now typical companies, what are these typical companies? These are often companies emerging or rapidly expanding sectors like technological, biotech, renewable energy. Now we also know that in our country like India or the developing nations, they are mostly focusing on renewable energies, biotech or technology, because we are lacking them. But in the case of developed countries, what is their focus? Their focus may be different. Stock characteristics. So how we can identify the such growing stocks or growing companies? If they have higher PE ratio and they may or may not pay dividends. Yes, they are not or may not paying dividends. I'm not saying that all companies are not paying dividend, but these companies mostly do not pay dividends. Why? Because if they are paying the dividend, it means they are not able to spend more on their future growth, because the they are reinvesting their profit to fuel their growth. And the third one is nothing but the high earning growth expectations. Risk. The risks are mostly associated with future potential, making them more sensitive to the price conditions. And the risk is higher in the case of growth investing. Why risk is higher? Because they are in the growing stage. We don't know whether it company will succeed or their plans are good enough to be matured, to be growing. But based on some characteristics, but we can say that they are growing. Return can offer higher return during the bull market or economic expansion. Whenever we are showing the bull market or economic expansion, such type of stocks are always increasing. The examples like investing companies like Zomato, Bajaj Finserv, Trend are the some classic example of growth investing. But when in case of value investing, we are seeing that these are the established or slow growing companies or companies that have temporarily fallen. They are already matured, but temporarily they are fallen out of favor with the market. Characteristics of such stocks: they such stocks have lower PE and PB ratios, may offer dividend as they are more stable cash flows, focus on intrinsic value often based on companies' asset earning or cash flows. Risk: such type of stocks are less risky because they are less volatile but can be underperformed during bullish market when growth stocks are in favor. Return: when we are saying that it's less risky, definitely the return is also less as compared to growth stocks. Examples of such companies like SBI, State Bank of India, Hindustan Unilever, GAIL are such examples of value investing. Now the major key difference of the growth investing focuses on future potential, often leading to higher volatility and valuation. Value investing focuses on finding bargains, seeking to buy stocks below their intrinsic value, that is also called as undervalued. Traders are always, or investors are always in a mood to find such kind of stocks that are undervalued. Just remember the example of 10 or 8. When the stock price is 10, that is their intrinsic value, but now it is value is 8. So this is called what? Undervalued. So I hope now it is clear that what is growth investing and what is value investing. So now we have a difference between growth and value investing. We already discussed, their main focus is on future growth, and value investing, their main focusing on intrinsic worth. Typical sectors: technological, biotech, e-commerce, renewable energy, and in case of value investing, we are seeing that traditional industries like manufacturing, finance, and utilities. Stock characteristics: high PE, high price earning ratio, then low PE, low PB ratio, and stable earning. It is a characteristics of value investing stocks. Dividend: no dividend are paid by growth investing, may or may not. But in case of value investing, usually higher dividends payout are there. Risk: higher risk due to future growth. Lower risk stocks are often already priced low. Return potential: high return during the period of economic expansion, but in case of value investing, solid return over long term, especially in downturns. Volatility: more volatile, less volatile. Investor objective: in case of growth, capital appreciation for future growth. In case of value investing, buying stocks at discount to their intrinsic value. Key metrics: revenue growth, earning growth, market share expansion. In case of value investing, price to P ratio, PB ratio, or dividend yield. Companies example: Zomato, Infosys, and Avenue Supermart. It is also famous as a D-Mart. Tata Steel, ITC, State Bank of India. These are the examples of value investing. Investor profile. Now just you tell me, in case of growth investing, who will choose? So we have to, for deciding, we have to keep in two things in our mind. First thing, what is the risk? So what will be your answer? Definitely it will be high. Yes. In case of value, what will be your answer? Definitely it will be low. So if it is a high risky, so it means that risk is higher. If you are a risk taker investor, definitely you will go for what kind of stock? You will go for growth investing. But if your risk is low and you are not in a mood to, okay, I am not such kind of investor who are taking much risk, so definitely you go for a value investing. So that is, if you are a risk taker or investor willing to take a higher risk, you will go for growth. And if you are a conservative investor, then you will go for a value investing. So I hope it is clear to you now that in which category you are following and which type of stocks are meant for you. Now just take the case. We will discuss the case of Zomato as well as Tata Steel. In case of Zomato, it fall under the category of growth investing stocks. Why it is called? Because they have the key matrices that will say that these belongs to growth. Why? Like when we are seeing high PE ratio, focus revenue growth, and no dividend, are we are seeing these three things in case of growth investing. Risk and reward, higher risk is there, higher reward is also there, because when we are seeing their data, we will find out the very good return they are giving. So that's why we have put this stock in growth investing category. Second thing is value investing. Value investing is nothing but the what we are seeing these three categories. In case of which stock? In case of Tata Steel, in our case, we are seeing the low PE/PB ratio, stable dividend payout, and this is undervalued in case because of some other factors, market conditions, and low risk is there and steady reward is there. Value investors view a value investor may choose Tata Steel, viewing a temporary low stock prices as a bargain, particularly if stocks believe that the steel cycle will recover and that the company is currently undervalued. That's why we have put in this category. I told you such value investing are nothing but they are the undervalued companies because of some conditions. For time being, their prices are low, so we are, as an investor, we are taking the advantage to buy at the lower price and we are selling in the long run. So it will be a good decision or a good move to book a profit. Next, comparison. So when we compare based on the above two case studies, one case study we have seen about growth and value of Zomato and Tata Steel, we can compare that, we can say that Zomato is a growth, Tata a value. Why they are attracted? Because of future potential, growth, and in case of Tata, the investor attracted because of their undervalued price. Volatility, Zomato has a more volatile and Tata Steel is a more stable. Dividend, are not paying dividend. Why? I told you earlier the reason, because of growth and expansion, but Tata Steel offer stable dividend to its investor. So both represents compelling investment but appeal to different types of investors. What kind of risk taker or conservative investor, but depending upon risk appetite, investment goals, and market outlook. Three conditions: risk appetite, investment goals, and market outlooks. So your selection will be based on these three categories. Now, which one is better for you? Which one is good? For long term stability, value investing has a historical provided more consistent and stable return over a long term, particularly for risk averse investor. So first of all, we have to identify which kind of investor you are. For higher growth potential, growth investing has a potential for higher return, especially in bull market, but comes with a more volatility, means high risk. So you have to take more risk to gain more profit. So conclusion, so definitely on the conclusion we can say that we are not always going toward the growth investing, we are not always going toward value investing, we are making a trade off between growth and value. So that is the balanced approach we are taking. And also we have to consider a market condition. So this is the data based on 2023. At that time we can say that this data is purely based on that time scenario. So but now the condition is almost the same. So we are seeing that there is a structural shift in digitalization and rise of renewable energy. Ultimately, which strategy is better depend upon market conditions, your investment horizon, and risk tolerance. Again, the same three conditions. On these conditions, your investment will be, your strategy will be changing depending upon these conditions. So I hope till now it is clear to you that what is growth and value investing. So if you still have any questions, or please write in the comment. Thank you.